The last couple of days, it's been tough not to just go back through all of my DMs to people on Discord and hand out "I told you so's" about a whole bunch of properties on Lofty. I think that that is not at all useful. But I think all of a sudden, well, I think we're starting to see more and more the cracks in the system of the way the co-ownership deals are structured and how investors on the platform are looking at deals. Like I said, I mean, I don't think it's helpful to point out, that these are. I think most of this stuff was obvious up front, but I do want to talk a little bit about why, what we can learn from this moving forward. Oh, by the way, it's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online as usual. So I just want to, so going to just point out real quick, three different properties. It's this one in 29 Palms. This was a short-term rental. Oh, what happened there? I don't know how I lost this. The other one was Brownfield. I think a lot of people in the Discord know what's going on with this one. And the other one's this Canyon Road one. The reason I'm picking these three out, they're all ones that I made videos of. This one I think had been up for a little while, if I'm not mistaken, when I did my video, because it might have been up from before I started, or maybe it was a Canyon Road. One of them was, but these are all ones that quite a while back, several months ago, maybe further, I did videos, and the fundamentals of the properties themselves didn't line up with the yields that we're getting, right? And this is one of the things that I'm always talking about, like how there's, the only reason we're making money on certain deals is financial engineering. And so like specifically on the two short-term rentals that I'm going to talk about, I pulled up what the top line revenue was, right? And just compared it to the price of the property, the value, and there's certain rules of thumb that investors in general like to use. I didn't make these up. Um, and if you can't come close to those, at least, it gets very hard to make deals work without sort of messing with the way the is structured, right? And so that's what was happening on all of those. Um, Basically, we had a revenue to price ratio that was significantly lower than what I'd ever want to buy a property at. And then because of that, you have no cushion, right? And so as the income and the performance goes down a little bit, all of a sudden, a lot of these, the yields drop to zero or very close to zero. Brownfield was a little bit different. There were certainly issues with the property itself. And I had some real questions about the valuation, and I still do. But the big one on this was the debt, that the behind the scenes debt. And one of the things I want to let you know where I'm going with this before you click away. Probably too late for a lot of people. I'm going to do some math today around the 999 Canyon Road proposal that's out. I think the brownfield thing, I'll probably do a video in the future, but I think there's too many different thoughts being discussed to really dig into the math of any one proposal. But so that's my goal tonight, like, is to try to share how I'm looking at these when they come out, and hopefully help some people make a better informed decision than they might otherwise, or at least bring up some ideas for us to talk about in the Discord. By the way, please like and subscribe. Tickle the like button. If you haven't joined the Discord, there's a link in the description to this video. You can join there. There's a bunch of us that talk about deals every day on a lot of different about a lot of different platforms. I think it's been helpful for a lot of people. I know I've gotten a lot out of it. There's a couple of really bright guys that have joined and are sharing info about properties that I've missed. There's also links to all the different sites that I'm currently investing in fractional real estate on. Just because I invest in a property doesn't mean that you should. Do your own due diligence on the platforms and the sites. Okay, so Brownfield, I think it was just from the analysis that I did on it, and you can go back probably 6 months ago or however, whenever this came out, and look at that video and see. I think it's really clear that the property doesn't support the debt, and even if it worked out, if it got to um, the end result, the stabilized level that they thought, it still was not a great deal, with the debt that was in place. And if you don't know anything about multifamily debt, it's not like getting a loan for a home where you can, they just look at the property and don't care about the financials. to get good debt on a multifamily property of this size, you need 2 years of solid financials. At a minimum, you need 12 months. If you are lucky, they're going to underwrite 12 months um, of expenses, and you're trailing 3 months of your rent roll. That's the absolute best that you can hope for. But if you've had this, the way that the debt was on this, I mean, it looked like it was going to be impossible to outrun it as far as um, it just looked really tough to begin with. And so, obviously, if everything had gone perfectly, maybe they'd be in a different spot right now. But if you don't know, the co-owner was he came onto the into the lounge in the Discord and talked a little bit about how, he's just basically stuck with it, right? And so that's my main point is this deal and the yield up front only worked for two reasons. One, the co-owner was paying a rental yield, and two, he was paying the mortgage, right? And he did have a slightly inflated or had an inflated management fee to help him with the mortgage. But it was, that management fee wasn't covering the full amount, right? And so one of the things, and that's what's happening in all of these deals, right? You see the reason the high yield exists is because somebody's paying the mortgage outside of the structure of the property. And I know I've said this a bunch of times, like you just have to worry about like, can they really pay it? Well, it turns out in this situation, he doesn't think he's going to be able to continue to pay it. It's creating a real problem because the property is not performing up to where he expected it to, and so he's having to continue to pay the rent credit, and I think that this is a predictable result. This isn't the only property it's happened with. We've seen we've seen this on a couple of other co-ownership properties already. Some that have larger disputes, but where there's a situation where the finances for the co-owner, for the person who brought it on the site, no longer make sense um, for them to pay the debt, right? And that's what I think. It's why I think the number one thing that we have to do is look at the property and say, okay, if we get to that point, what does this deal look like? And if that's a negative cash flow or an anemic yield, uh, is that something that I have any interest in investing in, right? And so that's this one had no yield this month. The price really tanked. I feel like they've struggled for quite a while, and maybe the co-owner on this one sort of went silent. I haven't followed it too closely. Someone pointed this one out, but I know when I did the video, I had real concerns about their revenue to price ratio was too low. I talked about that one. I'm sure over the next several weeks we'll have a more in-depth discussion about Brownfield. But here, 999 Canyon Road, it's another one where when I first looked at this, it's a beautiful property. It looks like it should be a great short-term rental, but the top line revenue just did not match up with the value that we were putting on the property. And now, revenues dipped a little bit, and all of a sudden, now there's not enough income at all for the property. And to his credit, the co-owner on this one is being proactive, and he said, "Hey, look, guys, what I think we should do, we should switch this to long-term rental. We'll sell off the furniture and recoup some expense, and whatever I get for that's going to be distributed." I mean, I think he's being proactive and he's doing the right thing, but I think he's a little bit trapped by this whole setup. And I'm going to do some math around this. So, okay. And when we're, because one of the things that I think is happening is we're starting to get into these situations, and then people are really kind of panicking and just doing the first thing that they think of. And now, does this make sense to switch this to a short-term rental? One, there's a couple. I mean, from a short-term rental to a long-term rental. I'm going to do some math around it. I think we're probably going to find out maybe. But the other thing, this is a different situation because um, the co-owner still owns the vast majority of the tokens here. I think he's only raised like $70,000 or maybe even a little bit less. And so, in this situation, I think, he's going to want one. He's going to have a lot more control. So I think whatever the vote is, as long as he can get a person or two to agree with him, it seems like it should probably go through. Um, but also too, he hasn't sold out a ton of equity at an inflated price and really benefited from that. Where on Brownfield. I mean, in some of the others, that's really what happened, right? They brought it to the platform. Maybe, they had a high appraisal, but whether or not that appraisal made any sense relative to the value of the property as an investment, I think most of the time I don't necessarily agree that it does. At least the ones that I choose not to invest in. And so, they sold out equity at a premium, and then okay, now we're stuck, and now okay, let's let me change the deal basically, and I think a lot of the co-owners want to do that and change it in a way that benefits them, but not have a negative impact because they sort of ignore the fact that they already made their money, right? They got that inflated sellout now. To his credit, Austin acknowledged that on Brownfield and said, if I need to, give up some of my equity that I have in it, if we need to burn my tokens, if we can come up with a solution that seems like it's going to work, he said he'd be open to that at least. And so at least he's not keeping that reward and then having the DAO be stuck. But there's certainly other properties that is the case. Some of the Yom ones that the DAOs no longer even own those properties. Um, the debt structure is especially with the co-ownership ones that got taken over. I just see those as like they just don't make sense for the co-owner if the DAO runs it without them, and the co-owner has to make the payments, right? And so that's where I think this structure over and over again doesn't work. You hear me talking bad about the rent credits and about financial engineering in general and about the debt structure, and I want to make it clear, um, I'm not opposed to those things if the deal itself works on a fundamental basis, and then you want to start tweaking some things to make the yields even better for people, to make it a more attractive deal. I'm fine with that as long as the fundamentals make sense where the property could sustain the debt by itself. And so that being said, I want to just jump into okay, what happens if we switch this, um, to a long-term rental model? And again, this is just me doing guerrilla math. I haven't done, I probably spent 20 minutes before I hit record to go through this. Some of this thing could be not accurate. Some of it I'm just taking straight from Lofty. Some of it I'm just using like very general rules of thumb. But so okay, the co-owner said okay, I think it's going to rent for about 2250. I'm just taking his word for that. I always put in some vacancy collection loss. You just have to do it, right? To ignore the fact that there's going to be turnover or there's going to be times where you're not collecting is just reckless. And so I always put that in. 5% is the absolute lowest I'd ever go. Um, it sounds like he already had something lined up, and I just wanted to look at okay, if we had in a perfect world, does this deal make sense, right? Just keep that in mind too when we get to what this deal looks like. So after your vacancy collection loss, you've got your net rent 2138, 10% management fee. He did mention that if we switch to long-term rental, this was a discussion in the Discord. I don't actually think this was part of the proposal. Because he's currently earning, I think, 25% management fee and using that management fee as a way to pay part of the mortgage. But he did say he'd be open to moving it to 10%. But whether or not that's the case or not, it's not part of this proposal, right? And so we're going to look at it both ways. I'm going to look at it at 10% and then move it to 25. For taxes and insurance, I actually think I flip-flopped these two numbers, so I'm just going to say insurance and taxes. These I just pulled straight from Lofty's financials tab. So, this is what they've already had in there. Again, I didn't do any, if this is your deal and you're trying to figure out the math of it, you want to do more than just watch some guy on the internet talk about it, right? But I'm just trying to share the way I look at these deals, what I think like on a fundamental basis, does this make sense as a property? And then that I think should inform the decision going forward. Okay, what are we going to do, right? Repairs and maintenance again. Absolute lowest I think that makes sense to use is 5%, so that's what I put in. It's only $113 a month. Um, that might sound like a lot on a monthly basis, but okay, $1,000 repair and that's almost your, that's almost your whole year of repairs and maintenance. So it's very easy, it's very easy to hit that, and whether or not that should be a higher number is something that you have to really think about. Um, Got my total expenses here, and then so my net operating income, 1510 a month, and so that's about $18,000 a year. Okay, so under the current structure, where the co-owner's continuing to pay the debt, the principal and interest, right now, there's 5,371 tokens that are assigned to debt, which, at $50 implies an equity value of 268,550. Honestly, I think the $50 number doesn't make any sense to think about anymore, because if you look at the current price, it's 38.43. But anyway, at $50, that turns into a 6.75% yield. I know if you bought this before the last couple of weeks, you probably spent $50 on it. Um, Equity at $38, which is just the current price. Switching it to long-term rental, it's an 8.88% yield. So on the surface, it's not terrible, right? It's not what people are looking for on Lofty in general, but that seems like that's a pretty good deal, right? I mean, that's if I were able to get 8.88% in a lot of other places, I'd be happy with it. Um, but keep a couple things in mind. That's comes with the risk that we've just talked about on this platform. Um, and this isn't like getting a 8.88% cash on cash return on Mogul, for example, because we're not getting levered appreciation on this one, right? The benefit of the leverage from an appreciation standpoint goes to the co-owner, not to you. So, if I had to choose between getting this 8.88% and getting 8.88% on a deal that I'm buying on Mogul, I would choose the Mogul deal all day long because, again, you're getting the levered appreciation there. You don't have this strange, mortgage setup where you're basically getting diluted over time. Or that's the same thing. I said the same thing twice. Sorry. But you don't have a situation where you're just really counting on that co-owner to make that deal work, right? One of the things I wanted to look at is, okay, what's the principal and interest payment? Again, it's outside the Dow, but these are things we really need to start thinking about. And then I wanted to look at the debt service coverage ratio. So that just means I'm comparing the net operating income to the debt service, that, just the principal and interest portion of the debt service. It came out to 1.15. When I used to work in lending, if you were looking at an income property, you really wanted that to be 1.25 or 1.2. In times when we'd get real aggressive on deals, we'd get all the way down to 1.1. So, 1.15, I don't love it, but it's at least you have some cushion. And that's what, the coverage ratio is basically saying for every dollar of debt service, I've earned $1.15 in NOI. And so that means I have a little bit of cushion for things to go wrong. So okay, I'm kind of okay with that. I don't love it, but I don't think this isn't like setting off any red flags for me. The alarms aren't going off. It's something that, though, if you're in this deal, you have to really think about. Or if you're thinking about buying at 38, because there's a lot of people that see that 38 and be like, "Ooh, what a big discount! This was $50 2 weeks ago. Let me buy some." And it's going to be a long-term rental, and we're going to get a good yield. But you have to think about, does this deal make sense on its own? Um, and then what am I doing here? So this is cash flow, right, after the debt service. Because one of the things I want to look at is, okay, what if the Dow had to take over this deal? Let me not confuse you yet with it. So if the Dow had to take over, right, the mortgage payment, for whatever reason, let's just say that happens. We've already seen now there's, so, lots of, it's a risk that the Dow has, right? Somebody else is paying that mortgage. We don't know anything about that person's financing. If it happened, all of a sudden, uh, our cash flow after debt service is only $2,358 a year. When we compare it again to our equity amounts, it's either a 0.88% yield or a 1.16% yield. I don't love that at all. It doesn't leave a lot of cushion, but at the same time, it's way better than, if you do this same math on a lot of the deals on the platform, this is a negative number. And so that's when I'm terrified. This isn't exciting at all, but and this is actually how like I would never buy this deal in real life, right? If I'm looking at this property in real life, I'm always going to look at what the mortgage payment looks like relative to the property. And if I'm getting a number like this, it's not going to work. And it was really easy to figure out this was not going to work because um, on a fundamental basis, it doesn't work well because okay, we have a property value or a market cap of 543,000, and actually, what did they do the 530, and I think this is the inflated one. It's 505 was the appraised value. Um, you know, for me to be interested in a deal, if I'm paying $500,000 for it, I want to get, 3,800, $4,000 in rent at a minimum. And a lot of people want to stick to a 1% rule and say I want a $5,000 in rent. Now, that's not really realistic in a lot of markets today, but I certainly don't want to cut it in half and go below that, right? And so that's why, as a long-term rental, this isn't a deal that anyone would buy without this situation where the owner's paying the debt. Um, so what I want to do here is think a little bit about, well, okay, what does that look like for the owner to pay the debt, right? So we're going to look at the owner's share here. Um, and this is a situation now where uh, they haven't. And I guess one thing I didn't do is add back in the management fee. But if we do a 10% management fee, well, let me do the math first, and then talk to you a little bit about the management fee because I guess that is something that maybe makes it a little bit better. But so, okay, he's currently owns 3,988 tokens, almost 75% of the tokens in circulation. So again, in this scenario, he owns almost all of it. It is he's being proactive. Like I don't mean this to be in any way negative about the co-owner here. Um, he's trying to save things, but I think it's a good way. This is just a proposal that's out there. I think it's a good way to really think through like what this looks like. Okay, so because he owns about 75%, his share of the NOI is, and I did actually just did that division, but his share of the NOI is about $13,454 from the tokens, right? And so okay, and then the debt service is $15,000, and this is both of those are annual numbers. So he'd actually lose $2,308 every single year that he continues to do this. Well, you can say, well, wait a minute, let's give him add back in the management fee. That's 10%, right? Okay, well, let's do that. Now he's actually making $200 a year, $250 a year to manage the property. That's a tough spot. That it's the reason that we want to look at what that co-owner's situation is because um, at a certain point, and hopefully he's doing well, and you just don't know, right? And this is really a lofty problem. It's not a this co-owner's problem, right? Is we're in a situation where we're buying an investment, we're counting on somebody else to pay a large expense that is our expense, right? Because there's a lien against our property, but we're not given any financial information about that person who's and so I want to really think about, okay, who's my counterparty, right? Who's the co-owner? What does this deal look like for them? Wow, that looks pretty terrible, right? And okay, he did just get $70,000 from selling a little bit of his equity. Um, and relative to maybe this still makes some sense for a while, and if he's able to still sell some here and there, he should be fine, I would think, but I don't know, right? And so this is one. When I did this, I feel like it's okay. I'm not as worried about this as some of the others, but it's certainly I'm not excited to buy this token at $38 even, right? Like it seems like a big discount, but I'm not excited about it. And let me show you why. So, okay, what's the alternative here, right? Obviously, running it as a short-term rental doesn't make a whole bunch of sense. Um, Switching to long-term rental, okay, well, we get a little bit of a return, but again, it's really just all coming because the owner's willing to continue to pay that. It's not a super exciting return, but it's better than nothing. Um, the alternative that comes to mind first is, well, what if we just sell the property, right? And that gets you, uh, you know, I use the sale price as just the appraised value. That was a year ago. There's no Zillow or Redfin or Realtor info on it because it was a vacant lot and he built the property. Is 505 a reasonable price? I have no idea, right? I took that price, subtracted the debt service, subtracted, I used 8% selling expenses. I always use that. I feel like it's relatively conservative. Maybe there's some wiggle room there, but that assumes, a 6% commission and then 2% of additional closing costs. I add in the operating expense or the operating reserve. So this is actually added. And then, 2,500 in unpaid bills. At the moment, I'm not aware of any. Almost every single sale that I've had with Lofty, there have been some unpaid bills that pop up. They take out money for final utilities. They take out money for, the accounting at the end of the year. Like there's always something. Maybe again, maybe there's a little bit of wiggle room, but that just leaves $190,000 in net proceeds divided by all the equity tokens. You're only going to net $35.39 if you sell it for what it appraised for last year. Now, Ogden, it looks like moved up like 1.5% in their median home price. Would you get more for this? Maybe. But selling it doesn't look like it makes one of the things that I've started to think about on Lofty is, okay, if I can sell my tokens for about what I would net when I sell the home, it probably just makes sense to just sell my tokens if I want to, and not try to push to get that home to sell. It's only when you're getting a big premium that I think it makes a lot of sense. So here it's a spot where, okay, maybe we're stuck, right? Um, I think if I were in this, uh, I don't think we're getting back to 50 anytime soon. I think that is probably pretty clear. Yeah, I guess we have. I guess it's been a little while that it's been moving down, but and we only go. Oh, there we go. Look at that. I didn't realize that was fixed. So I guess it's been moving down longer than I realized. But when I looked at it, it was still higher up. So that's interesting. It's been moving down for a while. So maybe you bought it at a little bit cheaper and you're fine. But if I were in this token and I'm okay, I can hold it and I can get a yield based on my hold is somewhere around 8, almost 9%, or I can sell this token and reinvest somewhere else. For me, I'm selling if I'm getting to that price, right? And there's no reason for me to push for a sale because I don't think I'm going to get net more per token. Um, if I think that 8.88 is the best I'm going to do, well, maybe I'll stick around for that. But I don't know. It's hard to. I think this one is you're just kind of in a tough spot, and it's because the fundamental revenue to price wasn't there to begin with, and then a lot of stuff, a lot of properties that are a good, and then things got worse from there, right? Like if this had been a 20% revenue to price ratio, which is what I usually look for, somewhere 18, 19, 20% for a operating short-term rental, and honestly, sometimes I'll go as low, depending on the you know maybe for this one, if it was 16 or 17, I might have been interested, because of the quality of the property and whatnot. It was new construction, but regardless, if you had a high number like that, and then you had it drop off from there, you could still be profitable as a short-term rental, right? Versus when you're already very thin and you're only getting a good yield because of this debt structure, then as to things, it just makes it an extremely fragile yield, right? And so, unfortunately, I don't think that I have a good thought of something else. Could you try to switch this to rent by the room and maybe do a little bit better? It is furnished already. Maybe that's something to think about. Um, I don't know, but for me, if I were in this one and I'm looking at that 38 price, and maybe if it pops a little bit I'd sell, or maybe I would just sell there and move that into something else. But it's hard to see over any intermediate term, this getting back to 50 if it gets switched to a long-term rental, because your yield is just, it's, yeah, 50, your yield's going to be 6.75%. Now, I say that there'll be plenty of months where you have no repairs and maintenance and there is no vacancy or collection loss. And so then it is a better yield. But on average, these are going to be your numbers. And then the other thing, I did want to move this to 25% and then just see how much. So if he switches it to long-term rental but keeps the 25%, then all of a sudden, okay, Well, it's kind of a wash, right? Because he owns such a high percentage of it. So he has negative $5,000 in cash flow, but then his management fee is 6,400. So okay, then he's actually making, well, in negative, so he's making like 1,250 or 1,300 or something um, a year, right, to manage it. So maybe that's not terrible. Maybe leaves him in a little bit better spot, but it's still, it's not a great spot to be in. I mean, basically working for free. I mean, not completely free, but not a whole lot of money at all. And and he's got all that money tied up in it, right? I mean, like a big chunk of equity. This is how much. Let's look at that times the 50. Oh, yep, that's not how that works. Change it there. Yeah, almost $200,000 in equity tied up, but based on the appraised value at least, um, or based on the $50 token price. So really, it should be a little bit lower, but regardless, a big chunk of his money that he's basically getting zero return on because it's all going to the cash flow. I guess he's unlocking some tokens, so getting to dilute the DAO a little bit each month, but it's not a ton. I think in the debt service, did I? That's equal 19. I think here, yeah. I don't remember which one was principal and which one was interest, but so maybe getting 10 or 15 tokens each month. Each month? 10 or 15? No, that's not right, right? Yeah, that'd be 10 tokens if that's what 50, and that'd be like 50. Okay, yeah. So, maybe getting something out of it from there. It is. It's a tough spot to think about, like, well, why, I guess just trying to hold on to the asset and thinking that maybe sometime in the future it'll be a good short-term rental again. The problem is you mentioned like, hey, we got to sell the furniture to do this, which I think he's right. Long-term rentals normally don't rent as well if you have furniture in them than if they're unfurnished. I think in some markets there might be some exceptions to that, but at least that's what been my experience. There's a lot less people looking for a year lease, and they don't already have some furniture that they're going to move in. But so if we do end up selling stuff, and then okay, sometime and then we end up deciding we're going to switch it back to a short-term rental sometime in the future, well, then we have to go and spend the money and buy that stuff again, right? And so that we've seen in some of the other DAOs that can be pretty expensive. Furnishing, decor, all the little stuff. So either that's got to stay in storage, and then that costs us a little bit extra, um, or we have to just rebuy it if that's the plan in the future. So, unfortunately, I don't have, and I don't know that I pointed this out. If you could tell, I had a little freeze and I just tried to record past it. But yeah, with that 25% management fee, your cash on cash for the token holder gets even worse. If he doesn't agree to change that to 10. But it seemed like he was open to that with this proposal, but it didn't. I don't believe it was included in there. I could certainly be wrong. I don't know why. Have I had my picture down here the whole time, or did that just reset down there? We'll have to find out later. Sorry, I'm a very bad YouTuber. I am trying to get better. I watch videos on how to be a better YouTuber. If you have suggestions for me, please tell me, right? Hopefully, this kind of stuff is helpful. I think a lot of people are seeing these proposals and one, either just taking the proposer's word for it, what it's going to look like, or just doing like really, really rough math. And I mean, what I did here is pretty rough, right? This is not the model that I use when I go buy properties for myself. This is just me putting together something pretty simple, not digging into any of these numbers too deeply, taking a lot of the platform's word for it, because I don't have, this is not one that I own, because when I did my original due diligence, I thought this is not going to make it for me. Um, I really don't mean to be so smug about it, like I know a lot of people bought into a lot of these different deals. And it's just becoming, I think, more and more clear to everybody how much the structure puts us as token holders really at odds with the co-owners, because we have a very different situation because they're stuck with the debt and we're not. They make their profit from the structure upfront from their sale and getting a premium on their sale, and then all on the back end by diluting us with mortgage payments. But the current yield is such a better deal for us, right, as the token holders. And so we're in a spot where we don't have great alignment of interest because of it. And I think it's just going to be more and more problematic. I've talked to Earl about this quite a few different times, and he thinks, and one of the things we've discussed is uh, just doing all of these sales as if it were a subject to sale, where okay, the Dow has to pay for the mortgage. And one of the things that would happen if we made every deal like that, it would be really obvious that some of these deals are terrible deals because they'd have very anemic cash flow because the cash flow wasn't coming from somebody paying the debt outside of the structure, right? And so outside of the entity. And I'm not saying that this would be necessarily one of them. I mean, this was one that I chose not to invest in. It certainly, I don't mean to pick on it. There's been a whole bunch of these that I think, didn't really work on a fundamental basis the way I look at deals. Um, but looked amazing from a yield perspective because of the structure, right? And so I'm going to keep complaining about it. Hopefully now my goal is to just really have all of us pay a little bit more attention to it. I think if there were a lot more of us doing that and then not buying these deals when they come on the platform, like I talked about, yeah, I think last night, if you watched my long rant, I think we just need to force the platform. We need to force Lofty to provide us better deals or just not invest, right? Have to create a situation where people aren't going to be able to sell out deals just because they're doing some rent credits or just because they're covering the mortgage and uh you know unless if that's what they if it's the only way they know how to bring a deal to the platform, Lofty, not the co-owner, uh because they just I don't know, for whatever reason they really seem like they don't want to learn about it, like how what a good deal looks like in real estate, or don't want to have someone on their team that can help them identify and attract the right kind of deals. And if they're not going to, then if we're going to count on co-owners having the financial wherewithal to pay us or to pay for more, pay rent credits, pay the mortgage, we have to be demanding more information about the personal financial info of those co-owners, right? I mean, because right now we are just getting this deal is really great yields because somebody else is paying the mortgage. Oh, can they afford the mortgage? Trust me, bro, that yield looks great, right? Like that's the conversation we're having at the moment. Um, and like I said, I mean, maybe this guy could pay this mortgage forever. Maybe he's doing perfectly fine and he's really just changing this up to help us a little bit. I think that's perfectly possible, but there's no way for me to know, right? As a investor on this platform, like that, Lofty is just not setting it up in a way for us to know that. But I think as long as these deals exist that have these like ridiculously high yields, they just see, oh, well, that's what our clients want. They keep buying it. Well, it's because that, I think a lot of people are not doing the math and they want it if it's really a 20% yield, but it's not. It's a 20% yield for 2 months and then who knows? So I don't know. Yeah, you can tell I'm getting, uh, you know, one of the things that's gotten to made me a little bit more frustrated is I didn't realize how many of the people on here that I think are like smart people that are looking at deals are putting a lot of money to work in properties that I just think absolutely made no sense for them to do it. Like I think it's and so it makes it more clear how much Lofty's presentation, their UI, and their structuring and the limited info that you get, how much that's tricking like even reasonably intelligent people that understand how real estate works are still kind of falling for the trap of um buying a bad deal with a good structure. And so I'm okay with the good structure, but we need to have a good deal first, right? Buy that good deal and then layer this on top of it. Okay, that's fine. Give me the bad deal, layer this on top of it, but give me a co-owner that I know can afford to pay it forever. I'm okay with that too, but having this situation where the deal itself the fundamentals are weak, but the um, but it works because of the structure. We just need something more. Or I think there's been a lot of discussion of, oh, once we get rid of all the legacy properties, the co-ownership deals are all much better. I was looking on Lofty Assist today, and of the co-ownership deals that aren't just still at 50, because some of them are still just selling out. 22 are above 50, 22 are below 50. So it's exactly 50-50 at the moment. And some of the ones that are above 50, I would bet lots of money that people are going to lose on in the future because of who holds the mortgage on some of them, and what just the general situation. That you can see some of the ones. I don't really understand how, like, you have some that the ownership is really struggling to own, struggling for control of the property, and somehow the tokens are still at $54 is just mind blowing. But anyway, I think now I've digressed like way too much. Hopefully, this sort of analysis helps. I'm doing it all the time when, I just, if I'm looking at a deal and there's a proposal, like, just open up my Excel, mess with the numbers a little bit. I think you really need to be doing that, because if not, there's people that are voting on, okay, and I guarantee a lot of the people that are voting on this proposal are not doing any math about it. They're just saying, "Hey, I like long-term rental. Let's do that. We've made no money up till now." And honestly, for this particular deal, maybe that's the best result at this point. Um, but this could be Odom all over again, where you have, we went from long-term rental and had a little bit of short-term rental in there, and then did mid-term rental, and then we're going to sell it, we're not going to sell it. Like, you can, we have, you could have a situation here where we switch without really thinking through, does this next move make sense? And so, I think every time that we are making a big change, we should think about, would it make sense to just sell this in real life, right? Or me as a co-owner, or as a token holder, I think, should I just sell the tokens at the current price? And I think, for me, if I were holding this one, that'd be my solution at the moment, because I don't think we're getting more on a sale, and I don't, I'm not particularly excited about the current return as a long-term rental. That'd be what I do. And yes, it would mean if I bought it at 50 that I lost some money, but I think I'm going to make that money back quicker in another deal than I am leaving it in here, right? And so that's that sunk cost fallacy I think a lot of people fall for. They're like, ah, I just want to keep it in here so I didn't lose money. Well, you already lost it, right? Maybe there's some way this gets back to 50, but it's hard to see how that happens as a long-term rental. Um, yeah, I think that is everything I want to say about that. Do the thing with the bell if you haven't already. Um, and like and subscribe. And thanks for listening this long, because I think this was probably a long one. Until next time, I'm going to keep making mistakes so that you don't have to, but also trying to avoid a lot of mistakes and sharing the ones that I think I'm trying to avoid. So hopefully this helps you a little bit.